So, let's talk about the stock market. I wish I could tell you I had a secret formula to calculate when the market will explode, but unfortunately, I haven't solved that yet. Even though I don't know the secret formula, I have learned some techniques over my several years of investing to help narrow down the best stock options. Let's jump right into it. If you're new to investing, here's a quick rundown. A stock represents a small piece of ownership in a company. The objective is to buy stock in business you believe will grow over time, so your investment increases in value. But figuring out which stocks to invest in, that's where most people get stuck. There are two common approaches to stock analysis: technical analysis and fundamental analysis. Technical analysis is all about studying charts and patterns to predict short-term price movement. This will be used more by day traders or those who are looking for short-term gains. But I prefer fundamental analysis, which is focused on the company's financial health, leadership, and overall reputation, especially when you're investing for the long term. When it comes to managing risk, I tend to lean towards index funds. These funds allow you to invest in multiple companies at once, which helps spread the risk around. My favorite index funds track the S&P 500, which covers the top 500 public companies in the US, and the NASDAQ, which covers the top 2,500 tech companies. I do still pick individual stocks on occasion, as these could lead to greater yields. If you're looking to start your investing journey, there are a few platforms that offer free stocks when you sign up and fund your account. Public, for example, offers free stock worth up to $50, and Robinhood, which I'm sure you might have heard of, but maybe not for the right reason. Now, after you get your first free stock, how do you decide what to invest in next? One thing I always start with is the company's financial information, which is called quantitative analysis. The important things to check are the balance sheet, the income statement, and the cash flow statement. I'll show you what to look for. First up, the balance sheet. This shows what the company makes, assets, and what they owe, liabilities. To determine if the company is too risky, compare their total current assets to their total current liabilities. You want the company assets to be higher than their liabilities. Next is the income statement. This shows the company's revenue and expenses. A quick way to measure profitability is to divide the operating income by the total revenue and multiply by 100. Operating margin you look for depends on your current situation and financial picture, but I recommend about 15% or greater. Finally, we have the cash flow statement, which shows us how much cash the company is generating. This analysis is more simple, as you just want to make sure the company has positive free cash flow, which means they have money left over after the expenses to reinvest or pay dividends. If a company is losing money but still handing out dividends, that's not a good sign. It's simply just not sustainable. After reviewing the numbers, I dive into qualitative analysis, which looks at factors like the company's brand and leadership. Think about a company like Coca-Cola. Its name alone brings instant recognition, and that strong brand loyalty plays a big role in its success. Leadership matters too. A great example is Tesla, which is closely tied to Elon Musk. His presence and influence are key to Tesla's brand, so any major shift in leadership could impact the stock. That's why I always evaluate how much a company relies on a single leader and whether that's a strength or a potential risk. Even something like a controversial tweet from Elon can drop the stock. Emerging industries and future trends are also on my radar. For instance, electric vehicles and renewable energy are growing sectors, and Tesla plays a major role in both. Paying attention to industries on the rise help identify growth stocks and could skyrocket in the future. Timing the market is tricky, and no one can predict the best moment to buy. So the best option, instead of guessing, is to dollar cost average your money into a stock. This means invest the same amount of money at regular intervals regardless of the performance at that time. This helps even out the ups and downs in the stock price, so over time you get an average price of the stock. When prices dip, I see it as an opportunity to buy more shares at a lower price. This way you don't have to play the market timing game. In the end, successful investing is all about patience, research, and staying consistent. Keep an eye on the fundamentals and don't let short-term hype mess up your vision. Make sure you subscribe for all the best finance and crypto tips. I'll see you in the next video.